Hi there, I'm Paul Bagnall, and this is Market Call today on BNN Bloomberg. Our guest today on the program is Andrew Moffs. Andrew Moffs is Senior Vice President and Portfolio Manager at Vision Capital. He's an expert in real estate securities, and that is the focus of today's program. So get your questions ready on real estate investment trusts or other publicly traded real estate entities. Andrew Moffs will answer those questions. Andrew, thank you very much for joining us. I should, before we move on to talk to Andrew about his market outlook, just give you our toll-free number, which of course is 1-855-326-6266, and our email address is marketcall@bnnbloomberg.ca. So please do get your questions in. We're just one segment away from getting into those questions with Andrew Moffs. Andrew, you made the point in some earlier notes that when the market sold off in a big way in March, it was indiscriminate in the case of real estate stocks, as it was in many asset classes. But as the markets rebound, not all real estate entities are the same. Not all geographies or not all asset classes within real estate will benefit as much from the economic recovery. Where do you see the winners and the losers?
Great. Well, thanks. First of all, thanks for having me on. It's always a pleasure being on your show. You know, if you look at what the Canadian REIT index did from high to low, from February highs to the March lows, it was off about 48%. We've only recovered to being down 30%. So you have to ask yourself, are the price of buildings, as you look out your windows, are the price of commercial assets off 30%? And undoubtedly, because of the pandemic, demand and supply fundamentals have changed. Across the board, we don't think they're off 30%. So your question is right. What asset classes, what geographies should one be focused on to find the value? And we at Vision, using a top-down approach and then going bottom-up, trying to find the discounts within those sectors, we're primarily focused on residential, pretty much all forms of rental residential, and we can talk about those, the industrial warehouse space. And we also are very much focused on, well, the different asset classes within residential, which we can get into.
Investing in real estate often involves the so-called hunt for yield. Many real estate publicly traded entities are distribution-paying entities like the real estate investment trusts. How are those yields looking right now?
Yeah, well, there's two things we focus on, the demand and supply fundamentals, and then as a result, how consistent is the cash flow? How dependable are those cash flows in this environment? So sure, the yields have gone higher. That makes it attractive as an initial look. But at Vision, what we're focused on is fortress-like cash flow. We've seen many REITs so far cut their distributions, suspend their distributions. You know, if you're in the hotel space, you haven't paid a dividend in many months because the cash flows aren't there. So you really have to look to the source, the dependability of those cash flows. We see it in the industrial space. We see it in the apartment space, for example. But we don't necessarily see it in the retail space. You know, you see stats like 25% of tenants in the mall, in the enclosed mall, have paid their rents. That's not going to bode well for the sustainability of those dividends in the future.
What about the role of private equity, institutions, pension funds? Typically, real estate has been very attractive to those type of investors through the cycles. Where are they sitting right now in terms of their appetite for real estate?
Yeah, real estate, I'd say for the past 15, 20 years has been really a desired asset class by pensions institutions globally as rates have gone ever lower. And we're just in this almost lower for longer period in terms of interest rates. So as they look for alternatives, real estate looks increasingly attractive as a real asset that should capture inflation when inflation comes and protects you because those rents should go higher. So your point is quite valid there. We have seen record amount of institutional capital sitting on the sidelines, private equity, looking to get into real estate. And what's happened since the pandemic is there's been a total freeze on the transaction market. There's a disconnect between what buyers are willing to pay and what sellers are willing to accept. So what has that done? That's forced a lot of private equity to look at the public markets, where if you go back to my example, if REITs are now off still 30%, there's a large disparity there. There's a wide discount to net asset value, which these institutions can take advantage of. And our strategy is trying to buy real estate cheaper in the stock market than the private market. And I think you're going to find more and more institutions are going to follow that strategy as we get out of this period that we're in.
Those are the opening thoughts of Andrew Moffs. He again is Senior VP and Portfolio Manager at Vision Capital. We'll take a break, but when we come back, we'll start putting your questions to Andrew Moffs after this. Welcome back. We are back with Andrew Moffs of Vision Capital. He's going to take your questions on real estate, publicly traded real estate. Our first email comes from Shirley. Shirley writes as follows: is it a good time to buy Dream Industrial REIT at this price? Dream Industrial REIT, ticker symbol DRI.U on the TSX. Andrew?
Yeah, so Dream Industrial is a stock we've owned. We think it's in the right sector, in the industrial warehouse sector. We're certainly in the earlier innings of a whole change in the supply chain in terms of what e-commerce is doing to the need for more and more warehouse space. Dream Industrial has recovered off its lows. At this point, it's certainly a safe hold. We think where investors might have questions is they have a bit of smaller bay as opposed to the modern new logistics style warehouse. So if you think about the smaller bay, they might be more susceptible short term to the economy, whether it's your local tile guy or gardener that might have had troubles recently. But we think longer term, this is a really good stock to own. We think it trades at a discount to net asset value, and the distribution is quite safe.
Okay, thanks to Shirley for our first question. Let's go to the phone lines now. Stephen is in Calgary. Hello, Stephen.
Yes, hi there, Paul. First-rate show. Andrew, I wanted to ask if you think that Minto Apartment REIT is trading at an attractive discount to its net asset value, and do you think that their core rental markets in Toronto, Ottawa, and Montreal will continue to be strong in 2020? Thank you.
Yeah, pleasure. I think we really like Minto. That's a stock we own. We certainly think it's a buy here. It trades at a discount to net asset value. You are right. It's focused on the key urban centers in Canada. Probably one of the most urban portfolios you can find in terms of concentration. So trades at a discount to NAV, benefiting from up until now quite record immigration into Canada. That will be a pause short term, absolutely. But as we look, and this is what we do at Vision, we have a forward view, a forward NAV, and as we look forward, we have to believe that immigration should continue. But notwithstanding that, the fundamentals in their markets have been really strong. To trade at a discount to NAV means how dependable are those cash flows? Well, their market rents are much higher than their in-place rents. So even if you've had a short-term disruption, which we've had now, there's still a very positive mark-to-market, meaning every time a tenant moves out, you can still move the rents higher. And we think it's anywhere from 15 to 25% pre-pandemic, and we still think those are very strong numbers for the cash flow going forward.
Thanks to Stephen in Calgary. Carl in Toronto is our next caller. Hi, Carl.
Hi, Paul. Thanks for taking my call. Andrew, when you last spoke about INTERRENT REIT about 4 months ago, you indicated you liked the company, but you were a bit concerned with the stock price. You thought it had got ahead of itself a bit. So my question is, now that the stock price has kicked back about 25%, have you been tempted to reestablish a position, if you had one before, in INTERRENT? I appreciate your views. Thanks very much. Stay safe. Cheers.
Thank you. Yeah, so INTERRENT, you're spot on. At the time we thought it was fully valued, and I think they've recently issued equity, so that's always a good sign that management agreed that now was a good time to raise equity to take advantage of the opportunities, because when you raise equity, you have to have a view on your stock price, and they certainly thought their stock price was close to net asset value, so we tended to agree. So at this point, we think it's a safe buy for sure. They are great operators. I think out of all the residential operators in Canada, because of their new Montreal focus, it might be a little choppy in the short term in terms of some of their downtown core assets in Montreal. If you think about, they have some concentrations to the McGill, Concordia student population, where you might not see the students or foreigners return for this semester or this coming year. That might weigh slightly on leasing, But looking forward, I mean, this is a company that's focused on the right geographies, great management, and we really like their value-add approach. So I would be comfortable owning that stock here.
Thanks for the question, Carl. Let's go to Vancouver now. Peter standing by. Hi, Peter.
Hi. Thank you for taking my call. Great show, great host, and great guest. Andrew, I think you and your colleague are the best REIT managers. So may I have your expert opinion on Crombie REIT? Thank you very much, Andrew. You are the best.
Thanks. High praise, Peter. Thank you. So yes, so Crombie REIT is a retail REIT focused on the grocery-anchored shopping center area in Canada. They are owned, their large owner is Empire, the owner of the Sobeys brand, and Sobeys that also owns Safeway in the West. We think this is a very safe hold at this point. Their rent collections, that's been a real focus of investors. What has been the rent collections through the pandemic? And for Crombie, the rent collections have been quite high, and that's because food is a necessity, and that's always been the argument, and it should be more defensive. At this point, the stock has sold off quite a bit. It sold off from where they raised equity not too long ago. So if you own the stock, it's probably a safe hold here. The distribution is certainly a safe one, just given who their tenant base is. The question will be, what will be the growth in the future? And so that's why we're probably not as optimistic on the retail sector going forward. I think there'll certainly be some secular changes, as e-commerce becomes more of a player in the grocery sector. But for now, certainly Crombie is hold.
That's Andrew Moffs. He's our guest. Thank you to all those callers. We'll take a break and be right back with more questions for Andrew Moffs. Welcome back. We're back with Robert Moss of Vision Capital. Real estate investing is our topic, and our next caller is Robert. Robert is calling us from London, Ontario. Robert, welcome to our program.
Thank you. I'd like to ask or get Andrew's comments on Northview Apartment, whether it's a safe hold, and if not, if there's an alternative REIT in that sector that he can recommend. Thanks.
Great. So Northview Apartment REIT is supposed to be going away in the next couple months. It's the subject of a takeover by Starlight Investments. So if you own it, you might consider holding it through to the closing, because there's still an attractive spread to the takeout price of $36.25. Plus, you'll collect distributions along the way. Or you may choose to take that capital today and reinvest in another apartment REIT. And I would certainly be comfortable with you doing that as well. Any of the names, whether it's a Minto or a Canadian apartment REIT, Cap REIT, we think are two great options to invest in on the Canadian multifamily side. But again, with Northview, your upside is capped from here, but it's an alternative to holding cash today.
Let's go to Kelowna, BC, where Brian is standing by. Good afternoon, Brian.
Good afternoon. Does your guest know of an ETF that would cover UK real estate? I'm a small investor. Is there any other way I could get involved in that market? If so, thank you.
So thanks for the question. On the UK side, off the top of my head, I'm not familiar with an exact ETF that focuses on the UK, but it's quite possible. There are ETFs that mimic what's called the FTSE NAREIT indices, and that's the global NAREIT is the global body for public real estate companies. So you could take a look at that. With regards to the UK, if I was forced to, I would look at SEGRO. That's an industrial REIT. Ticker is SGRO, focused on distribution warehouses in the UK, with exposure also on the continent. It recently raised equity, so its balance sheet is in good shape. And we continue to believe the industrial warehouse space globally will continue to see growth, and that's a company where its NAV should continue to grow.
Okay, thanks for that question. We're going to go to one more caller. That caller is Dave in Toronto. Hi, Dave.
Hi. Thank you for taking my call. Andrew, in the past, you liked Sienna Senior Living, and I wanted to ask you versus Chartwell. They're both kind of in the same space, and they're Sienna, I believe, is near the 52-week low. I think it's like a 10% dividend, and to me, it's like a one-time opportunity to buy Sienna Senior Living or Chartwell. I'm not that really well-versed in this kind of space, so I wanted to ask you, for a young investor that doesn't need the cash for 3-4 years, would you and are you buying one of these two stocks, or maybe both of them right now, for a long-term hold? And would you take advantage of this opportunity? Thank you. And for which stock? Thanks.
Yeah, no, thanks for the question. And it's a pretty astute question because, if you had asked me a few months ago, let alone a year ago, if those stock prices would be where they are today, I obviously wouldn't have thought so. And it's sad what the pandemic has done, focused in that sector, particularly, of course, in the long-term care sector in Canada. So Sienna has had to make some difficult changes, management changes, look inward to see how they operate. At the end of the day, the long-term care sector is an important needs-based sector in Canada. And what will have to happen, particularly in Ontario, is for the government to look at how they can properly fund that business, both for nonprofits and for-profit owners alike. So with question marks on the horizon in terms of the funding mechanisms for those businesses, we tend to focus more on Chartwell today because the predominant cash flow for Chartwell comes from the retirement and assisted living sector as opposed to the government-funded long-term care sector. We certainly think there's a lot of value in both companies, but on a risk-reward basis, you're probably better off owning Chartwell today. Also, great management. They've done a phenomenal job operating through this tough time during the pandemic, and we think you do have the ability to buy it at a deep discount to NAV today. You might have to withstand some short-term volatility, but as you pointed out, if you're a longer-term holder, you are certainly looking to buy a good platform today. Chartwell might be it.
Okay, let's go back to the email inbox before we take another break. Mark is our email correspondent. His subject is Choice Properties REIT. That's ticker symbol CHP.U on the TSX. I'm wondering what you think of Choice Properties REIT for an increased position.
So Choice Properties is similar to Crombie, has a large holder. In this case, it's Loblaws, and Loblaws is one of course, their largest tenants. So I'd say about 75-80% of the business is in retail. The balance industrial, office, and some residential. We think very highly of management. You have a very competent management team, probably one of the best in Canada between their CEO and their CFO. That said, the value of the company today is pretty well valued. They're probably trading near, I haven't looked closely at the moment, but they're probably trading near their IFRS values, their net asset value. And it's a very safe company between the cash flow from Loblaws, Shoppers, et cetera.
Okay, thank you to Andrew Moffs for all those questions. Thank you to our callers and email correspondents as well. We'll take another break. This time we go to past picks from Andrew Moffs after this. I'm Paul Bagnall. This is Market Call. Our guest is Andrew Moffs of Vision Capital. He's an expert in real estate investing, and that's the theme of today's show. It's time now for Andrew Moffs' past picks. We'll take a look at picks that Andrew gave us here on Market Call just over a year ago, a year and a bit, April the 30th of 2020. First top pick, Andrew, BSR REIT, that's ticker symbol HOM.U on the TSX, recommended on April the 30th, 2020. I'm sorry, it's not just over a year ago, it's just several months ago. $9.75 was the price when you recommended it. It's now trading at $10.78. That's a return of 11% since the end of April.
Yeah, it's a stock we continue to own. We are a very large holder of this company. We think highly of management. They're focused on the U.S. Sunbelt, predominantly in the state of Texas. These are multifamily, affordable apartment units for rent. in those cities like Dallas, Houston, Austin, Oklahoma City, et cetera. And it trades at a very wide discount to net asset value, over 20%. And we think the arbitrage is there. We see this often where you have Canadian REITs that own exclusively U.S. assets trade at wide discounts to NAV because local investors in Canada don't understand the true value of the assets, and U.S. investors tend not to come north of the border to get U.S. exposure.
Why does it trade here in Canada?
When the company went public, they decided they were too small of a market cap to grab the attention of institutional investors in the United States. And there's been a very decent track record of these smaller companies going public in Canada, wider acceptance with the retail shareholder base here. And for us as real estate focused investors, we're agnostic where we buy shares of companies, and we think this is a really great opportunity.
Okay, next one sounds like a similar entity. It's called American Homes for Rent. AMH is the ticker symbol. It trades in New York. It was recommended on April the 30th by Andrew at a trading price of $24.14 on that day. It's now trading at $26.93. That's a return since April the 30th of 12%.
Yeah, so AMH, similar in the sense it's housing in the United States, but this time these are single-family homes for rent. What's very interesting post the pandemic has been a recent trend of deurbanization. For people that have been living in city centers like New York, San Francisco, et cetera, there's been a desire for now more open space. If you can have a backyard and not have to deal with elevators and pay similar or less rent, that's a good proposition. So that coupled with work from home and the need for more space, you can't really work from home efficiently if you have a roommate and you don't have an office. Single family rentals in the United States have really taken off. So this is a sector we've been extremely focused in, and AMH is one of the leaders in that sector. And yet it still trades at a discount to its net asset value.
The final of the past picks that we'll deal with is WPT Industrial REIT. Ticker symbol there, WIR.U, here on the TSX, here in Toronto on the TSX. Recommended on April the 30th at a trading price of $11.47, now trading at $12.87, a return again of 12%.
Yeah, I guess that's a lucky number for us. WPT is just like BSR REIT in the sense of its U.S. assets listed on the Toronto Stock Exchange. This time it's focused on the industrial sector. What we like about WPT is that they're focused on modern logistics warehouses, so much larger facilities that can accommodate e-commerce. And with the rapid rise in e-commerce post the pandemic, this is a space you want to be in for sure. And so we continue to own WPT. We think it's undervalued and still consider it to have quite a bit of upside.
That's Andrew Moffs and his commentary on his past picks, which he presented to us on April the 30th of this year. They were BSR REIT, American Homes for Rent, and WPT Industrial REIT. We will take a break, and when we come back, we get back to your questions for Andrew Moffs. Welcome back to Market Call. Now we're back with Andrew Moffs, and he is, of course, an expert in real estate investing with Vision Capital. He's taking your questions on real estate entities, and Tom in Kingston, Ontario is our next caller. Hi, Tom. Thanks for calling. What's your question for Andrew?
Yes, good morning. Thank you, Paul and Andrew. Or good afternoon, sorry. Andrew, I have a self-directed plan, RRSP, which I've run for about 20 years. About 5% of that I hold in the cannabis sector, and I've been looking at adding, but not just growers or sellers, and I've been looking at IIPR. as a play. My couple of my concerns is that, of course, coming out of the States, the dividends take a bit of a tax hit, although it is protected, so I don't have and I also don't have the Canadian advantage. So, but I'm wondering about your thoughts on growth going forward.
Yep. So thanks for the question. So IIPR, as you mentioned, they're focused on the cannabis space in the United States. They're actually the only publicly traded REIT that focuses on this space. I like to view this company as a net lease REIT, meaning it simply owns a shed and its tenants take care of the rest. So they don't have to put any dollars in. The tenants just pay the rent, operate everything else, and all the landlord does is just collect the rent. In this case, and what you want in those structures is a company to trade at a premium to net asset value, premium to the private value of its assets, so that it can go out and purchase more assets and issue equity to the public markets to purchase them, and hence those acquisitions are accretive. So today that's the case. IIPR trades at quite a premium to its net asset value. It recently raised equity. It doesn't have any debt. So from that perspective, it's in a good spot. I'm not as well versed on the cannabis sector, and for me as an investor, when I see a company trading at a premium to its net asset value, it's not something I tend to own, and hence today I wouldn't necessarily be an owner of that stock. You'd have to own it because you believe in its growth profile, and the growth profile is contingent on it being able to continue to acquire, which it probably can do. It's got a good management team, but it's also contingent on having the right currency at stock price. So as soon as you see that stock price come off, that stock could just drift into a bit of a penalty box, and you're just simply going to be collecting the yield.
Okay, thanks for the question, Tom. Let's go to Markham, Ontario. Noel is standing by. Hi, Noel.
Hi, Paul and Andrew. Thanks for taking my call. I have a small position in H&R REIT, and I'm underwater right now, but I'm just wondering, is this a buy, sell, or hold given the current conditions? I'll hang up and listen. Thank you very much.
Yeah, H&R REIT has been a very difficult stock to own. It's down to very low stock price today. It just recently cut its distribution in half. Management said that they were being cautious and hopefully being overcautious in terms of where they set the new distribution. But it's really contingent on two things. And the two reasons they had to cut their distribution. One is your outlook on the retail space, and primarily your outlook on enclosed malls here in Canada. They own Primaris REIT. And I think earlier in the show, I referenced the fact that you have tenants only paying about 20-25% of the rents. Well, that's a very tough statistic. And if you're trying to sustain a dividend distribution, that's a tough metric to overcome. And then they also have quite a bit of exposure to oil and gas tenants. So they have, of course, the large Bow office building in Calgary. They own a building called the Hess Tower in Houston. Those are assets that you have to underwrite the tenancy, and already, the tenancy at the Hess Tower, they've already put sublease space on the market. So it's a tough stock. We think it's at these levels. It certainly seems your upside is much better than your downside for sure. Like I said, you just have to underwrite those cash flows going forward. We think their industrial holdings and their apartment holdings in the U.S. are solid. They have some really great developments. And if so long as retail stays stable from here at their portfolio I'm talking about, and they can find a financing or a way to reduce their exposure to those oil and gas tenants, you might be rewarded in that stock.
Okay, thanks for that question. Selwyn is in Thornhill, Ontario. Hi, Selwyn. How are you?
Well, thank you, Paul. And I'd like to ask your guest, Andrew, about smart centers. I originally bought them at $14, paying 10.5% dividend, and they're presently around about $21, paying 8.5% dividend. Would he add to the position, and does he think that the dividend is safe? And if you could give me a market consensus. Thank you.
So thanks for the question. I think you certainly timed it right in buying Smart REIT. Perhaps you might consider what your next move is. I mean, we think, first of all, it's safe in terms of that distribution. They have predominant exposure to Walmart, and Walmart is obviously one of the preeminent retailers globally. So we think in terms of the cash flow, it's pretty safe. But this is a company with zero growth in terms of their internal cash flow. They were already losing occupancy pre-pandemic. I mean, it's coming off of tremendous highs. I think I want to say 99%. But their same store metrics, their net operating income growth was only 1%, 1 to 2% pre-pandemic. So they have quite a bit of leasing to do. It's a tough space to be in, the retail space today. We think they have a good management team, and they have some really, really exciting developments on Metro Center, for example, here in Toronto, that could add to the net asset value. But they're a bit of like being on a treadmill today. Every dollar of value creation that they have, that they're fighting hard against either cap rates going higher or rents either staying stagnant or potentially losing tenants going forward.
The analyst consensus on these the units of this REIT: 3 buys, 5 holds, 0 sells. The blended price target among the 8 analysts who cover the stock, $25.75 Canadian. Thanks to Selwyn from Thornhill for that question. We'll take a break, but we'll come right back with more questions to Andrew Moss. Welcome back to Market Call. Andrew Moffs is our guest, and he is talking real estate investing. Susan in Scarborough is our next caller. Hi, Susan.
Hi, good afternoon, Paul and Andrew. I am the bewildered owner of First Capital Realty for the past 19 years. I haven't seen any dividend increase in the past 6 years. Went through the conversion to a REIT last year. Grudgingly paid capital gain on my book value. Still in the red. Can't figure out what the heck's going on. Thank you.
So what's going on there, unfortunately, is that they are in the retail space. So, we've had callers ask about Smart REIT, for example, Crombie. Anything that is in the retail space globally is in a penalty box, and for good reason. The pandemic has shut down traffic globally to every shopping center, and as all that's done is, in April alone, e-commerce as a percent of sales increased from 15% to 25%. That was a number that was expected to occur in a couple of years. Well, we had it occur in a couple of months. So what does that mean? I mean, First Capital has dominant centers, neighborhood, grocery, shopping centers that should be defensive. But even those centers, you have to ask yourself, how important is it that I have a Longo's grocery store nearby when I can now buy it online? And that's grocery, forget about general merchandise, et cetera. So First Capital is simply just a victim of the sector they are in. You did suffer over the past year as their largest shareholder, Gazit, liquidated its position in the company. So today you have to ask yourself, okay, well, what's the growth outlook? And the growth outlook has been diminished for sure. And the market has, I think, overly discounted that in some cases. And First Capital, that might be one of those stocks, but at the same time, the catalyst is lacking for the moment. And so you might consider looking into those areas where you have defensive attributes, where you can count on the distribution, because I don't expect the distribution to be increased at First Capital anytime soon, and where you'll have growth in rents. And so maybe you'd find that more in the industrial warehouse space or in the multifamily apartment space.
Thanks for the question, Susan. Let's go to Brampton, Ontario. Ron is standing by on our phones. Ron?
Hey, Paul. Hey, Andrew. Thank you for taking my call. My question to Andrew is regarding Killam Apartment REIT. I bought the stock a little bit early during the pandemic sell-off, and I'm standing around $18.50 for that. So do you think it's, just want to know your view, actually, if it is good that I keep on holding that, or, sell it off and move to another, like a Dream or RioCan. Thank you. I'll hang up and listen.
Yeah, so that's a great question. Killam, I would actually add to your position here. When you are looking at quality assets in a quality sector, if you have a view on its value, there's no reason why you shouldn't add to it on weakness. And I think Killam, if you look at that stock on an implied cap rate basis, meaning where the stock price is trading, what the market is valuing its asset as, its assets at, it's at an implied cap rate of 5.5%, the going-in yield for those assets. Meanwhile, that's a really wide spread to where those assets would trade in the private market. So we think it's trading at quite a bit of a discount to net asset value. It actually has one of the youngest portfolios in Canada of apartments, and that's an important statistic because, as we know, apartments need a lot of capital expenditures put into them every time there's turnover. Every time a tenant leaves its suite, you need to put a lot of dollars into those units. The older the building, the more dollars you need to put in. So Killam, I think, with its exposure in the Maritimes, as well as a growing exposure in Ontario, they also have exposure to the manufactured housing sector, which we really like. That's the mobile park sector. We think it's a very solid cash flow, very defensive asset class, and the stock is trading at a discount to net asset value. So I would continue to own it. We own the stock, and we've been buying it.
Rom in Calgary is our next caller. Hi, Rom. You're on the air with Andrew Moffs.
Great show, like always. These U.S. warehouse industrial REITs, they are always selling at a very expensive price, usually near the top of their price range. Could any one of these provide decent return from elevated price levels like Prologis, XTO Logistics, or Equinix? Thank you for your thoughts, sir.
Great question. We like Prologis. Prologis is the dominant owner of industrial space globally. Yes, at any given point in time, a stock might look expensive. So you have to look forward and say, okay, in a year from now, where do I think the stock will be? If it's in a sector where rents are not going higher, perhaps it won't go anywhere, and all you'll do is collect the dividend. If you think rents are going higher, occupancies are going higher, then if cash flow is going higher, the stock should go higher. And certainly in the industrial warehouse space, we think that's the case. I mean, it's stunning, some of the statistics. I mentioned earlier about what e-commerce penetration has done in terms of going from 15% of retail sales to 25% of retail sales. That gain alone in April, you can say that the United States needs another 140 million square feet of industrial to meet that demand in e-commerce alone, just from that one statistic. So we think it's still early innings in the global industrial warehouse space, and that's why I continue to recommend owning something like WPT REIT, WIR/U on the Toronto Stock Exchange. There you get exposure to industrial warehouse in the United States, but at a discount to net asset value.
Thanks to Andrew for those questions. Thanks in particular for our callers and email correspondents for their questions. We will take a break. When we come back, top picks from Andrew Moffs are next. Welcome back. This is Market Call. Andrew Moffs is our guest. He's at Vision Capital and an expert in real estate investing. Time now for Andrew's top picks. And Andrew, number one on your list today for our viewers is TRICON Capital, TCN on the TSX.
Yeah, so TRICON Capital, they're doing business as TRICON Residential. They are primarily focused on the residential rental space in the United States. Their main focus is single-family rentals, just like American Homes for Rent. Their focus, however, is more mid-market than their peers. So what does that mean? They're in the same markets as American Homes for Rent, for example, where they go out, they buy single-family homes, and they go out and rent them. However, the rents are lower. Lower meaning on an absolute basis, but because they are in the same markets and they buy a smaller box, they're actually the same on a per square foot basis. So we think they're buying quality assets, but affordable for tenants today. So this trend of deurbanization is really favoring TRICON's strategy today. I mean, at this point, they're just about 98% occupied in their homes. They don't have any more homes to rent. And on their own accord, they haven't been passing through rent increases for good social reasons. That said, there's been so much demand for people leaving high-rise apartment buildings into their single-family homes that I believe they're going to start passing through rent increases to their residents. This is a stock that already trades at a 20% discount to its net asset value, if not more. And we think it's really attractive when you compare it to stocks that we also like, American Homes for Rent and Invitation Homes in the United States, that trade at much lower discounts to their net asset value.
Okay. We had a call during our show about the possibility of a REIT that focuses on British real estate. Here, your second top pick is, in fact, a TSX-traded REIT that focuses on, if I understand correctly, residential real estate in the Netherlands. It is European Residential REIT, ticker symbol ERE.U on, is it the TSX or the TSX Venture?
It's on the TSX Venture for another week or so, and then it's graduating to the TSX. Given its size, it's it's $1 billion market cap. It's sponsored by CapREIT. This is a great company. Why do I like it? It's focused on apartments, flats in the Netherlands. This is a country with a severe housing shortage, particularly since 2018. So in real estate, just like any other business, you have to be focused on demand and supply. So on the supply side, I just said there's no competition. On the demand side, you have a housing shortage. You have people moving into this country. It's the, one of the most densely populated countries in Europe. And what we like about the business is that you do have a rent regime, like a rent control, similar to Ontario, Quebec, in Canada, in the Netherlands. So about 45% of ERE's apartments are rent controlled, but they get very attractive CPI increases and plus with a spread on top of CPI. 55% of their portfolio is liberated, meaning they can go to market, and they've enjoyed over 4% growth annually. So we think there's a very attractive internal growth story here, as well as a first mover advantage where they have a very exciting external growth story. So the combination of those two, with the stock trading at a discount to NAV and the only player focusing on apartments in the Netherlands globally as a REIT, listed in Toronto, we think this is a great stock to own and buy today.
Top pick number 3 is Granite REIT, ticker symbol GRT.U on the TSX. Andrew?
Yep, so I've mentioned why I like warehouse globally. If you think about the pandemic, it's not just e-commerce penetration, it's also the fact that up until now, retailers really had just-in-time inventory, and all this inventory restocking so that they have more just-in-need inventory in the future. That could translate to anywhere from 300 million to 500 million of demand for square feet of industrial space over the next 2 to 3 years. Granite is perfectly situated with a great balance sheet to take advantage of the opportunity. We have a good relationship with management. If you ask them today, they think now's the time to be buying assets because the window might close. And in fact, whereas the rest of the world is worried about cap rates going higher, or said differently, multiples going lower, in the industrial warehouse space, people should be thinking about cap rates going lower or conversely multiples going higher. So now's the time to buy, and Granite is doing just that. So they've issued equity recently. They've issued very attractive bonds recently. The balance sheet, as I mentioned, in great shape to take advantage of the opportunity to buy assets today, hopefully at a discount in the private market, and enjoy growth in the future as they take advantage of a mark-to-market in rents in their current portfolio.
Andrew Moffs, I want to thank you on behalf of our viewers for providing your expertise today. Andrew Moffs is with Vision Capital. He's been speaking about real estate stocks and real estate investment trusts through the course of our show today. We thank Andrew for his time.